Okay, let's talk about breakouts. Now, breakouts can be very, very powerful, or they can be, depending on who you talk to, they're either the worst thing in the world or the best thing in the world. From my perspective, they are a very useful tool to have in your trading arsenal, but you have to use them with caution because, by the very nature of a breakout, you are chasing the market and it leaves you vulnerable. If you're day trading specifically, you've got to be very careful. If you're day trading in the market and you're day trading a breakout, you've got to be very cautious. Now, what I like to do when I'm trading breakouts is, the earlier on I've spotted the momentum, this is my general rule of thumb, the earlier on in the momentum, the more likely the breakout is going to be genuine. The later on in the momentum, the less likely the breakout is going to be good. Great example on Apple here. You've got a good earnings announcement here. Pushes up, drives higher. That breakout on a daily chart is valid. It holds, it carries on. It's a lovely place to have got long. You could trail that and you're looking absolutely fantastic. As you start to get higher in the move, further into the trend, and bearing in mind we had a little bit of a trend here, but let's just say this was the start of the momentum. We'd identified this. It's been repriced based on whatever comes out on the earnings. Look how more tricky and more challenging it becomes to trade breakouts the further you go on. Here, not too bad, but then here, kind of consolidating around a bit. Here, a little bit tricky, not much meat before it pushes lower. Here's a lot better. Obviously it doesn't apply all the time, and that's a decent move. But look again, if you can say that's a second phase of momentum, up here when we start to break through, again, you don't get much before it kind of unwinds. So what's the summary and the kind of premise to look at with that is that if you're going to trade breakouts, be very careful of the price position. As with any trading setup at all, you want to be trading as early on in the surprise, because by the very nature of trading, if you're trading a breakout, the assumption is that someone is going to come in after you've come in and buy that stock or sell that stock short, and follow and make that price move so that you can make money out of it. The later you are to the party, the fewer people are going to get involved. Now, sure, when you're in a really good strong trend, there's always a steady flow of buyers, and you're always going to get a supply demand just generally from the flow coming into the market. They're always going to want to buy the best performing stock, and you're always going to get that. However, if as traders we're looking to capitalize on a 2 or 3 week move and we've spotted some momentum, the earlier the better. Now let's have a look at some clues. I know we talked about the timing. Let's look at some clues as to how a breakout is valid or not. Now, I'm really generalizing with this because, of course, everything is different. But generally speaking, what we want to see is, let's say, for example, there's our high. When we break through the second test of the high, and this, excuse me, this is the same for a daily chart, a 1 minute chart, a 5 minute chart, whatever. You want to see that price doesn't go back and start playing around under that breakout level. If it starts to do that, you've got to be careful. Now, there's nothing to say that it doesn't carry on again. Of course, that happens quite a lot. But a genuine, strong breakout is going to push through, and it's going to hold above that breakout level. It's going to put a new line in the sand. It's going to say, and when you think about that from a buyer and seller's perspective, it's buyers saying, listen, I'm now prepared to pay higher. I still perceive this as value, and sellers haven't got the pressure to say, actually, you know what, I've got to tick it lower. They may well be just selling it still, but buyers are still paying up. And if you look at this, kind of a little bit of not the best example in the world, but again, my cherry picking rule of not cherry picking. If you look at this as a breakout here, we consolidate above the breakout far, far, far stronger than if you kind of break out and fake out and come back down again. So what do we want to see when we see that? We want to see volume coming in. I want to see good volume as well on the breakout. We don't have to have volume in my experience after the breakout so much. This would be nice to see volume here, but it's kind of, I prefer to see the price action accepting the breakout. The participants in that stock, in that index, in that currency, in that commodity, accepting that this is a new price level. Some time goes by. Time for me is more important with this, that we're holding there and we're looking well. If you've got good volume, that's okay, but for me, it's a double-edged sword. Volume means that there are participants, and it means there are sellers there as well as buyers. if you push up and you're getting heavy volume, that's all very well, but it also means there are a lot of sellers as well as a lot of buyers, because for every buyer there has to be a seller. So that's okay, but it's also fine for me if you push up and you're on light volume, because if you're on light volume, you're still saying, hey, there's no sellers here, and they've not come in and thought, hey, you know what, I'm getting a better price for my stock now, I'm going to sell it. They've not come in, they've not perceived that as better value. So for me, that's a good or a bad indicator. That's an okay indicator to say that sellers have said, actually, even though it's a better price, I still don't want to sell in bulk. And then the subsequent move is the important one. Obviously, if then we get some volume coming in and buyers start getting a bit more aggressive, that becomes a bit more interesting, because they're stepping up and scooping up and causing the price to tick up. But the primary thing I want to see is it holding above the breakout level. That's the ultimate golden rule for me. Others may have different things. Others may want to get involved immediately on the breakout. But for me, I want to see, always, there's a bit of a, a common theme, excuse me, with a lot of things I want to look at is kind of filtering the way they trade. So seeing the initial move, then seeing a subsequent move, and it allows me to quantify my risk a little bit better as well. If I'm trading purely the breakout, that's fine. And by the way, there are times when I will do that, and there are times when I think that's a very good strategy. If you've got the right momentum, this is not a bad time to do it. The right momentum, it's already, proven itself. You can take it because you kind of know that the chance of it working are great, and then this consolidation area just becomes a confirmation that you want to hold the stock a little bit longer. Let's have a look at another one, Snapchat, after we had these earnings. Now, if I'm going to a 15-minute chart here, guys, I remember because I was involved in this. The breakout of that earnings day high was a good place to get involved, and then you see it holding. This is the key of not a 15-minute chart. So the breakout happens, and you see it holding. It holds above it, it closes above it, a good sign. The next day it gaps above the prior high. All good signs suggest that this price level is now accepted as a new level. It's a genuine breakout. You're going to get some kind of move away from it. Some shorts may well be trapped, some longs might want to get involved, and all those kind of good stuff. So that's the way I approach breakouts. Same on a 1 minute chart, 5, 15 or a daily, looking at the volume, at the price response to the breakout, and then judging your risk management, your targets from that.